Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report. Corey and Chad here, your hosts for our weekend show. Also your hosts throughout the week on our website, podcast, YouTube channel, and even go to our new Substack page to stay up to date on all of our daily editorials and company updates from throughout the week. Just search the KE Report, whatever service you're using, you'll find our interviews there. On this weekend show, we're going to be trying to ignore some of this volatility, actually a lot of the volatility in the markets, in the metals, in commodities, focus a bit more on what's going on with underlying stocks, bigger picture themes to, again, kind of make sense of maybe the long-term trends of the resource sectors. The first half of the show going to be focused a lot on metals and mining. Second half of the show, we're going over to energy, oil, and natural gas. To kick off the show, we are chatting with Joe Mazumdar, editor of Exploration Insights. And Joe, as I said, we're going to focus more on metals and mining here. You came out with a report to your subscribers that focused on North American listed gold producers following their 2024 results. Now, this week we did have Newmont report their Q1 results. We really just want to recap 2024 in terms of production, performance leverage, free cash flow, valuations, all these things that really matter to these underlying companies and investors. Before we get into the actual data here, Joe, give us a bit of an overview of what this work entailed. What was it based on and your thought process behind it, please?
All right. Thanks a lot, guys. So what I did was I did the same process for the first half of 2024, where I looked at these same 21 major gold producers that are, like you said, North American listed. And I went through several metrics, like, what they produce, their margins, free cash flow, balance sheets, corporate costs, growth potential. And I sort of put that together in terms of saying, okay, well, who's doing well? And I also looked at just saying, okay, who did well in 2024 and who did well in the first quarter of 2025? And then I came up with a list of companies. And as we mentioned before the broadcast, is that it's a little bit of a cross section of the different companies. So, there's a few, major companies like Agnico and Kinross. There's Torex in terms of an intermediate, Alamos, Lundin Gold, and Dundee Precious Metals that stood out to me based on the metrics and the returns as being companies that are offering more than the rest of their peer group.
Yeah, and you can tell that when you look at the stock charts of those companies too. They've outperformed a lot of the other producers. But let's dig into the nitty-gritty here, Joe. I guess let's kick it off with the production. What trends did you see as far as was there growth in production? And did you distinguish between growth through acquisition or growth through development?
Well, see, first I based it on like what these companies were doing in terms of their production profile. And so the top 8 of that 21 peer group, they produced on average at least 1 million ounces, and they together accounted for a third of global mine production. And what you notice post Newcrest merger, Newmont has a considerable margin of production gap, competitive gap to everybody else. Barrick being the second one, and then followed by Agnico in terms of major peers. And then the other thing I'd like to point out was what had changed between the full year of 2024 versus the Q1 2025 in terms of returns. And so in 2024, the gold price was up about 27%. But the GDX, if you use that as a benchmark for major gold producers in terms of equity ETF that's done by Van Eck, that was up about 12 to 13%. So it's sort of telling you that the gold companies didn't have a lot of leverage. And that was for various reasons. A lot of retail buying of gold, in China and other places that didn't spill over into equities. Not a lot of US buying, especially in the first half of 2024. But that changed in Q1 2025 when the gold price went up for the first quarter. It's gone up since 14%, but the GDX went up 33%. So we're seeing more than 2 times leverage there with the equities. And we're seeing that return, and we're seeing exactly what people want to see. And so I took this forward in terms of those companies as I produced this analysis.
So, Joe, dive a little bit more into this production, though, because the one thing that we keep hearing is that we're not seeing production growth, which in this better environment where there have better margins, I think some investors would want to see production growth. What can you tell us about what's going on with the big miners, even with the mid tiers in terms of production and overall growth?
So what I did in my conclusion, let's say, it's best to come up with the conclusions first, looking at growth versus income stocks. So the generalists may not want growth, but they might want sustainable dividends. Others would be more interested in growth. The problem is that when you have an annual production of more than 2 million ounces, it's very difficult to show material growth. Like if you wanted 20% growth, you would have to come up with like almost 400,000 ounces produced per year, in terms of, a tier one asset every year to show that kind of growth. The other thing is you offer dividends, and that's easier or should be easier for big companies. But what I've also seen is dividends offered by companies that have assets in geopolitically risky jurisdictions that get discounted too heavily, that they think, for where they operate. And so that like Lundin Gold and Dundee Precious, they might have growth opportunities because they've got single assets or they produce less than 1 million ounces. But in terms of just getting a better discount rate on their future cash flow, they offer more dividend yield to get their discount rate down. Agnico pays the most dividends. It's got, moderate growth, I mean, which is incredible considering, how big the company is. And then the other stocks that have growth, in terms of the way I looked at growth, was take their inferred resources and proportionate by the total mineral inventory, which would be measured, indicated, and inferred. And the average was about 25 to 30%. And the ones that, showed up well in terms of the companies that had also performed well were like Dundee, Kinross, and Lundin. And what we've seen trying to get growth through M&A, as we saw, I think we previously discussed the Equinox Calibre thing, the demand for the Newmont divestitures. They got more money than they thought they would get in 2024. We saw that, the Gold Fields and Gold Road. Right now, Gold Road doesn't want to get taken out by Gold Fields. They'll rather take out 50% of Gold Fields. Just today or yesterday, we saw Lumina Gold in Ecuador get a takeover bid. And also, I just saw that 50% of Donlin that's held by Barrick is getting a $1 billion bid by a group involving, I believe, the Paulson hedge fund. So we're seeing a lot of that come up in terms of M&A, which is exactly what we expect in this rising gold price environment.
Yeah, I think a lot of people still want to see even more, but it's very encouraging, some of these big deals you just went through and some of them just happening recently. I think it's hard to ignore gold having performed so well really over the last year and a half, but also even over the course of 2025 and the margin expansion that we've seen in some of these producers. So you've got on here the expanding margins, and I'd love you to dig into how things started trending, because really Q3 we saw the misfire from Newmont, but a lot of the other companies were showing margin expansion. Q4, Q1 of this year, what trends are you seeing in the margins, Joe?
So there was a strong correlation between the outperforming stocks that I mentioned and margins. And so in first half of 2024, the margins were, between all-in sustaining cost margin, and I did a range to gross margin. And so gross margin wouldn't include capital. It would just be a top line, revenue, and then cost applicable to sales. And so that range was 36 to 46%. If you look at 2024, for the full year, that range went up to about 40 to 50%. The highest margin companies were some of these companies that I mentioned that outperformed. Lundin Gold, which had about a range of 65 to 75% margin, which was incredible. Dundee Precious, Torex, and then on the other side, Agnico, Alamos, and Kinross all had above peer group margins. In the mix, we'd include Endeavor and Eldorado Gold. But Endeavor, we know that their exposure to West Africa has probably held them back considerably. But what's driving that 65 to 75% margin at Lundin Gold is the 10.5 head grades that they got in 2024 at their Fruta del Norte underground mine in Ecuador. So, yeah, those margins definitely that had a strong correlation to performance.
Joe, how did you account for, as much as these are gold companies, we have seen some diversification into other metals, especially copper. Did that factor in at all to any of your analysis here?
Yeah, like when I say gold production, there's a bit of gold equivalence, but that gold equivalence only went to silver. So I did not include base metals. So if I were to do the EV per ounce for companies like Barrick and maybe even Dundee, it might sell them a bit short because of copper. But you could see that Barrick's leverage going forward, and it's probably already embedded in their stock, is that most of their growth is copper. Reko Diq is a copper gold project in Pakistan, but dominantly copper. Their expansion at Lumwana in Zambia, also copper. It's gotten to the point they would like to change their name from Barrick Gold to just Barrick and not have the gold moniker on it. Once you take the gold moniker off yourself, you might tend to show, you might not be on everybody's hit list for a gold company. But that's playing into their strategy. So we shouldn't be surprised if Barrick has less leverage to gold going forward, giving their overarching strategy for more copper exposure.
Yeah, that has been interesting to watch with Barrick and their focus on copper. And some people teasing they may go to Barrick Metals instead of Barrick Gold or just plain Barrick. So it's going to be interesting to see how they perform amongst their peer group that have that more gold focus when people are searching for gold stocks. But the reason they're searching is because it's undeniable the sector is making a lot of money. Question, Joe, is when you did your research, where was that money going? How much on G&A? How much is exploration? What about strategic positions in other companies or building projects? Where's the money going?
So I also looked at a proportion of revenue. I looked at three cost items: G&A, exploration, and financing costs. And so the ones that managed their costs very well in terms of those companies that outperformed were definitely Alamos, Torex, and Agnico. So Agnico performed the best out of the majors in terms of controlling their cost profile to well under 10% of their total revenue with respect to G&A, exploration, and financing costs. Lundin had the highest overall costs of G&A, financing, and exploration because they had a one-time financing cost that they took in their income statement that was related to eliminating their stream and offtake facility, which the market took that as a positive. Another one that had a high overall cost was Dundee Precious, but that's because they were spending a lot of money on exploration. And that exploration was translating to growth because a lot of it was to their Koka Rakita gold skarn project in Serbia, which would be part of the growth story. So both of those increasing costs, above peer group averages were met positively by the market because it fit into what the market wanted. The market wanted growth. They got it from Dundee with exploration. With Lundin, they wanted more leverage to gold. They get rid of the stream and the offtake facility. So it makes perfect sense.
Joe, why don't these guys start spending more money? Not necessarily on G&A, but in terms of either exploration, financing, new builds, or M&A, or quite frankly, returning money to shareholders. I feel like these stocks need to choose a path here. They need to either be growth stocks or income stocks. And right now, if they're not out there acquiring, I realize it's hard to truly scale up, but let's see some growth. Let's see them move forward some of the projects in their pipeline to build them a little bit faster, or return some more money to shareholders. A lot of these companies have managed their debt. They're building up cash. Why not give something back to shareholders?
So what I've seen in terms of growth versus income, in terms of the valuations and the performance, it didn't really matter which stock you were. like which strategy you were going for. What mattered the most, it seemed, was how well you executed that strategy. So, a lot of these companies have like a history of meeting production and cost guidance, always meeting it. So such that they get a premium because they always meet it. And when you don't meet it, which some companies have failed to meet their production and cost guidance, and sometimes they don't even meet their restated guidance, they get a discount. I mean, the same thing happened when I was at Newmont in the 2000s. We missed a quarterly guidance. And that discount on future forecasts keep going for several quarters until you have several quarters or more of meeting guidance. So the fact that some of these companies have 5 to 8 years of consistently meeting guidance and doing what they say they're going to do puts a lot more merit in terms of that strategy. So you might have a strategy that says, oh, we're going to grow, we're going to offer dividends, we're going to do all this stuff. But then they look at history saying, well, you've never been able to achieve that. So whatever you're telling me, I'm going to cut that by 50%. But if you've always been able to do that, whether it's growth or dividends or whatever that strategy is, if you've got a history of achieving it, you get a premium. And that's why Agnico, who don't have the same production profile as a Newmont or a Barrick, have continued to outperform them.
Yeah, it's a good point. The companies that are fiscally sound and can show that track record of doing what they said they're going to do and meeting guidance do get the premium like Agnico. When you look at the investor lay of the land, though, and who is investing in these larger companies, it sometimes differs a little bit from who invests in the juniors. Do you think to those kind of investors that are in these larger senior companies that a dividend's more important? Is the share buybacks more important? Or would you rather see them investing in growth? Because I don't know how many people get into mining stocks for a dividend yield. We're going to talk to oil and gas stocks later in this weekend show, and they pay 6, 8, 10% yields on their dividends. And they do have that track record of making it. So I think if people want dividends, they tend to radiate there. But are there people that want dividends in gold stocks, Joe? And are they more interested in share buybacks or growth?
I would say the generalists, not the institutional equity that are resource, focused, more generalists, they would be interested in dividends. They would be interested in the liquidity these big companies offer. But that dividend has to be sustainable. You can't go back and forth. You can't have a big hiccup with your capital expenditures and cut your dividend the next year. And Newmont had these issues, pre-merger with Newcrest, where they raised their dividends, and then when they blew out their share structure because they acquired Newcrest in an all-share deal, they lowered their dividends because they couldn't possibly make that same payout on that increase in outstanding shares. So, a consistency is what people are looking for if they're a generalist looking at dividends. And so that's probably the issue that generalists would have looking for dividends from a resource company that's more focused on gold. They wouldn't have a problem, with a dividend from a Rio Tinto or a BHP or a Vale, maybe, but they maybe have a problem with doing it off a gold only stock, given the volatility of the gold price and, the high cost of capital building these projects. So I would say that now there's an increased focus on growth, but as I said, a lot of these companies cannot grow materially. And even when they acquire, they're just setting the bar higher. So if they're a 2 million ounce producer and suddenly they're a 4 million ounce producer, the ability to replace reserves, let alone grow, just becomes harder and harder with these depleting assets. And so geologically, it's hard to find deposits that big that are gold dominant. Hence the reason a lot of these companies are, veering more to the porphyries, which tend to have more copper because they're bigger tonnage, they have longer mine lives, and they could set you up to produce, 300 to 400,000 ounces a year, but they'll also take a significant amount of copper.
Interesting. That's a good point, Joe. But it's one of those things like energy companies, right? They can have $100 million of free cash flow, and at the end of the year, they're going to have maybe $3-4 million on their balance sheet because they're investing in sustaining their production, growing their production, and then also returning money to shareholders. From the balance sheet perspective, is there something else these gold companies can do? I get it that it can be hard to consistently grow gold production or any metals production because of how labor intensive, capital intensive it is to actually mine these metals. But what about either A, holding some of these metals on their balance sheet, providing a bit of diversification there, or going downstream, trying to find other verticals, other ways to build out, who knows, refineries. We keep hearing that we need more refineries in North America, or any sort of vertical integration that these companies could separate themselves from being simply just a miner, pulling a metal out of the ground and then immediately selling that.
So usually, I mean, in terms of gold, since you produce a product at the mine site that's 99 point whatever, 8 whatever percent gold, and you send it to a refiner to get it to 99.9999999%, there's not much value add in the refining margin. There's more of a value add in doing maybe coins or something like that. And I think First Majestic was looking into that. But most companies, they produce a fungible product with respect to a gold bar. And that's pretty close to the end game. But it's different for copper and base metals and almost every other kind of metal, is that you usually produce an intermediate product at the mine. And then the smelter and the refinery becomes an issue. Most copper companies and diversified miners got out of the smelting refining business because they didn't think the margin was there. But now, you know, most of the smelting refining capacity obviously is in Asia, and 50% of the total is in China. And now that we're dealing with all these issues about tariffs and protecting one's industry, and, in the US, copper tariffs and that, but they lack the smelting capacity. And so do companies go and look at now increasing the ability to smelt within the States? I think there'll be a bit of that, but I think also new technologies like the Newton technology with Rio Tinto and some other ones like the Albion process, looking at leaching concentrates or leaching things with on a heap leach, the sulfides, to get copper directly, getting copper cathode directly versus sending it to a smelter. Those sort of plans make more sense right now than they did previously.
Well, Joe, one more area of the study that I think it'd be great to get into with you is, since these were mostly on the gold producers, their valuations. When you look at how the gold stocks by way of the GDX are being valued, again, it just barely got up over its 2020 peak recently, the GDX did, and it's still not even at its 2011 peak. GDXJ just this last week finally got above its 2020 peak. So even though gold has added on $1,200, $1,300, as of today, to what it was, what the gold was back in 2020, and the margins are significantly higher, the valuations don't seem to be there. But some of these companies you're looking at are the best in breed. So how did the valuations look when you dove under the hood?
Well, I'd say for those 21 companies, the average EV per ounce for reserves was about $570 per ounce. And then it was about half that for total mineral inventory, which would be measured, indicated, inferred. It's about $275 per ounce. And the best performer, risky because single asset, risky because it's in Ecuador, in the jungle, Lundin Gold. But then you go back and they have the best margin as well. And so they have the highest valuation. Other ones that have high valuations because they not only produce gold, they control their balance sheet, they control their costs, they have a history of meeting expectations with respect to production costs and guidance, are your Agnico, your Alamos, and let's say your Kinross, and that's all wrapped around jurisdiction as well, because a lot of these companies are offering a much better jurisdiction profile, let's say, than a Barrick that has, assets in West Africa. They continue to have problems in Mali. Their growth is copper, and that copper growth is Zambia and Pakistan. I mean, in terms of valuations, even though Torex and Dundee have done well on an EV per ounce basis, they're still sitting like under the peer group, Probably because Torex is a single asset producer in Guerrero. Apparently, people like Ecuador more than Guerrero, Mexico. And then Dundee's assets are in Eastern Europe, Bulgaria, and then they have their growth. Coca Rakita is in Serbia, and they have that other project in Ecuador. So, yeah, there's a bit of geopolitical risk taint on some of this stuff, but if you like knock it out of the park with respect to margins, offer people ridiculous dividends, and continue to generate a lot of free cash flow like Lundin, you will get rewarded in the market.
Fair enough. Markets can be efficient in that way. Hey, if it
Yeah.
sounds like if you're a better miner, if you do have better margins, you will get rewarded. When it comes to valuations, though, did you look back in history? How do current valuations relate to other market times, really broadly for the gold sector?
Well, I mean, if we look at a price to net asset value, back when I worked for Newmont and the M&A was hot and people would pay, a lot more for an asset than it was worth, the idea was that the gold price would keep going up. And so people were valued at 2 times price to net asset value, which seems ridiculous because most base metal assets are sort of valued at almost zero point 0.5 or zero point 0.6. So that option value on gold was what was embedded in that. We haven't seen that a lot, over the last several years. But now, as I showed or talked about prior, is that in Q1 2025, we did see the leverage these stocks are offering to the gold price as institutional equity generalists. And everywhere you look, I mean, you go on MSNBC and all these even, basic non-finance news shows, they're talking about gold. Everyone's talking about gold. And so when people talk about gold, then you go through, okay, what do I want to own? Do I want to own gold? Okay, so I'm going to buy gold. Do I buy a gold coin? Or do I want leverage to gold? Like, where do I get leverage? Okay, I can buy, gold equities. Do I buy a gold equity ETF? Do I buy a royalty company? Do I buy one of the majors? Do I take a chance on growth with an intermediate that's got a higher risk profile? All of that sort of is trickling down, over the last couple of months, to potentially more of the sector we're focused in on.
Joe, you brought up royalty companies there. Did you happen to look at how royalty companies fared versus the gold producer? Because they have gold equivalent ounces, the royalty companies and streaming companies, but did you do any comparisons between the two?
Yeah, well, the thing is that they blow away most of the producers because that capital and operating cost escalation risk and the ability to show diversification with respect to the asset profile, it's hard to beat. As well as people probably believe their dividends are more sustainable than some other producers. And so their valuations are prime versus these ones. So I didn't want to dilute the producers with the valuation of the royalty companies because they do get valued higher. Such that I would say now the producers, the big producers, their competition may not be the gold equity ETF or the gold price anymore. It might be the royalty companies.
Interesting. Well, the royalty companies, they're in a totally different world, especially when you look at margins and, as you said, their costs. They can control their costs way, way easier. All
But
this
hang on a
research.
second, just one more thing. So we talk about the royalty companies, and then today, we had a big positive in the portfolio. We had Origin Royalties getting taken out by Triple Flag, for $2 a share. 37 cents is a spin out, but most of it is for that 1% NSR on the Silicon Merlin project in Nevada, operated by AngloGold Ashanti. So these royalties are getting highly valued. So that's just sort of a testimony to that.
Yeah, hey, Origin, that's takeout at all-time highs. So the M&A, it's been in this sector now for a little while, and it does seem to be picking up steam to a certain extent. Joe, at the end of all this research, then, did anything really stand out to you in terms of what the best miners are in the space, which companies have some of the best forward guidance, which companies have been the most successful at controlling costs, at doing whatever? Any major standouts you can leave us with?
Yeah, absolutely. Like in terms of the majors, Agnico, stands out, and then below that would be Kinross. And so it's not the bigger production is what people are looking for. It's basically a combination of margin, controlling your costs, and meeting your guidance, and controlling your balance sheet, and not doing any very stupid dilutive M&A. And these companies have been able to show that. And then jurisdiction helps. Like, where is your assets? Where are your assets and your growth located? And so those are the companies that have done really well. Alamos had done a really good job, because geopolitically at one point they were overexposed to Turkey and Mexico, and now most of their exposure is in Ontario, with the Island Gold Mine, and they bought Argonaut and for the Magino deposit. So that's helped them out a lot. So, so you can see when you go, it's not just growth, it's not just dividends. It's a combination of factors that underpin why some stocks outperform others.
Yeah, fair enough. Also, consistency, it sounds like. You know
Oh
what?
yeah,
The
consistency.
ones that are just the better miners that run their businesses better, they perform better. I guess that's the big takeaway, isn't it, Joe? So stick with quality. I think
Well,
that's
I
the
would
quality.
say, I would say, like your comment on sticking with quality, like after the first half of 2024, I would have said, Agnico was overpriced. I would have said, compared to its peer group, I would have said maybe Lundin was overpriced, but this value proposition, in a higher gold price just keeps getting better. And people like a safe proposition. They don't want to take that risk on somebody that's operating in a country they don't want to be in, or operating a high risk asset or something like that. They would rather pay up a premium knowing that they get what they want, as well as further leverage to the gold price. And these companies have shown that, and the investors have reflected that in their shareholder returns over that period.
Joe, great having you on the show. This has been so informative. Again, Joe Mazumdar, editor of Exploration Insights. Highly recommend checking out Joe's newsletter if you want to stay on top of this sector, especially the equities and all the site visits that Joe goes on to. It's great having you on the show, Joe. Thank you very much for spending time with us on this weekend show. Everyone stick around. We are going to be right back, shifting our focus now to the energy sector.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
Welcome back. Continuing to listen to the weekend edition of the KE Report. We're now shifting our focus over to the energy sector, oil and natural gas, as we are chatting with Dan Steffens. Dan is the president of the Energy Prospectus Group. We bring Dan on every month to get an update on the oil and gas prices, as well as any of the underlying stocks that he sees as having a good setup, a good opportunity for investors to enter. Let's start off, Dan, real quick with the energy prices. Oil, natural gas, both have been under quite a bit of pressure. It was early this month where I think tariff fears, they even crept into these markets as oil went through a pretty major drop earlier this month. Beginning of April, it was over $70 a barrel. We got Liberation Day, all the tariff news, and oil dropped as low as the mid 50s. Now it's rebounded. It's in the low 60s, but still, oil is under pressure. Nat gas also under pressure. It's been going almost straight down this whole month, but peaked early in March as well. So, Dan, let's start off with oil, I guess, and natural gas. In your eyes, is this all just geopolitics and tariff wars that are drawing the energy prices lower?
I mean, there's some fundamentals, but I would say the fear of the tariff wars and fear of drill, baby, drill have been, a cloud over the oil market, and just the uncertainty with those things. Now, I do think the fear of drill, baby, drill is pretty much faded away. And I was saying from day one, there's no way these upstream companies are going to go out and drill, baby, drill to lower the price of their product. They're not going to do it. And if any of these public companies start using debt to drill, baby, drill, they will be crushed in the market. So they're not going to do it. And actually, a lot of them have just recently, when the oil dipped to 60, announced that they were cutting back on their drilling programs. So you're going to see the reverse. We're not going to have a surge in production. I actually think U.S. oil production has peaked, if not already, very, very close. And the data is just starting to show up on that. Now, the tariff wars, I don't know. My personal feeling is this is all part of negotiation, Trump's negotiation, and maybe, just maybe, he did it in April because there is seasonal demand for oil goes up and down. So you have space heating demand goes down for home heating oil, and you really haven't had the pickup in transportation until you start getting till the kids get out of school at the end of May. So you got that, and he wanted to did something to pull down gasoline prices a little bit. But we need the Canadian oil. We need the Canadian gas. I don't think there's going to ever be tariffs on Canadian oil and gas, but we'll see. I don't know. Then OPEC Plus comes out really the same day he announces the tariff thing. OPEC Plus comes out and says they're going to accelerate and make, instead of doing these 140,000 barrel a day increases month after month, they're going to move 3 of them into May. So they're tripling the amount they're bringing in May. And part of that was just to balance out because there was countries that were cheating already. So it's not going to bring that much more physical oil to the market anyway. But it's another concern, what's OPEC Plus going to do? And then, of course, you got the uncertainty. We kick Chevron out of Venezuela. That takes 200,000 barrels a day off the market. You got, what the hell are we going to do about Iran? I think Israel's chomping at the bit to bomb their nuclear facilities because they cannot allow them to get a nuke. And what's going to be the resolution of the Ukraine war? We have a ceasefire, then we don't have a ceasefire. So what's going to happen there? And of course, obviously, China's demand. But China knows they need the U.S. market. We know we need the China's stuff, and so I think that gets resolved. Now, natural gas to me is not as impacted by this geopolitical stuff as the oil market is. So this is the year where the gas producers are really in favor again. And so what's happened recently to the natural gas price just in the last couple of weeks is that the paper traders, the people that are trading the NYMEX futures contracts, got real bullish. So they went too long. They were overextended on the May contract, which is the one that's just now closing. And they cannot take physical delivery of the oil. So they have to close those contracts, take the losses, and roll those forward. So that's what caused the May front month to go down. But if you look at the strip, look out further on the strip, the NYMEX contracts for December 25 and January of 26. Today, this morning, we're trading at December was 443 and January was 471. Then EIA, just a few days ago on April 10th, they increased their forecast for natural gas prices to $4.30 average for 2025. So we're already, a third of the way through 2025. So 430 average, which means we're going to have to get up to 450 or something by the end of the year. And they increased their forecast for 2026 to 460. Well, I can tell you, if natural gas prices average 460, I got a list of companies that are going to be making a fortune because their lifting cost for some of these, I look Range today. Range announced their first quarter results, and their all cash lifting costs are only like $1. So they would have over $3 profit per MCF. And this is a company that produces 2 billion cubic feet a day. So, there's some big gas producers, EQT, Range Resources, Antero, they would be printing money at $4 gas. So that's just something to consider.
Well, Dan, you laid a lot out there. I was going to get into nat gas with you. Let's also bring into the equation that there's still a hesitancy from a lot of energy traders that nat gas does get into the mid fours, as you just laid out. So, beyond just the energy need for more nat gas power plants, there's the seasonality factor, but there's also the LNG export terminals, and we've given that a lot of airtime, but rightly so. This is starting to ramp up more and more as this year goes by and as we round into 2026. So by wintertime, let's just say that we are starting to creep up from the 3 range we're at now up into the 4s. Is it possible that if nat gas is in the 4s or 5s, that a lot of investors in the nat gas stocks are going to miss the window because they simply don't believe it's going that high?
Yeah, they might. And I think the companies kind of learned a lesson in the run up in 2022. You know, in August 2022, when it became clear we weren't going to be able to fill storage before the next winter arrived, the natural gas price in the US spiked to $9.30. I think there's still a chance we're going to see a bidding war like that. And that's caused by a bidding war between the LNG exporters and the utilities that bring gas to your home or business. And they get out into the futures market and they start bidding up their front month contracts because they want to take the physical supply of that gas and put it in storage for themselves. And I think there's still a chance to have, but maybe not. Maybe they get enough in storage. But right now, as of today, our storage is below the 5-year average. And keep in mind that the U.S. and Canadian gas markets have grown significantly in the last 5 years. The demand for U.S. gas is growing at 3 or 4 times the rate that demand for U.S. oil is growing. Our global demand for oil is growing. And, it's the clean fossil fuel. It's the only answer for electricity. You're not going to be able to build dozens and dozens of nuclear power plants in the next year or two. And these AI data centers are desperate to secure gas supply to build their own gas-fired power plants. I just saw Range Resources talking that today, that they're entering into a joint venture with somebody to build gas-fired power plants inside Appalachia, inside Pennsylvania, so they don't have to ship the gas out. They can just burn it right there to produce electricity and then ship that electricity to the AI data centers in Virginia or wherever they are. And anyway, it's a problem. And I think that problem, that electricity problem, the only near-term solution is natural gas. And that's really one of the main reasons I'm bullish on natural gas.
All right. So Dan, sounds like you are still bullish. Oil, natural gas, broadly, you do see opportunities here. Well, let's talk about some of the companies that you want to bring up that you sent over to us. The first being Hemisphere Energy, traded HME. Like this is more a Canadian junior upstream oil and gas company. We've had Hemisphere on the show a couple times. I believe this is more or less a growth story, but take us through what you like about Hemisphere and it's really your forecast for it.
Well, Hemisphere really is kind of a one asset company. And so you got that risk, but it's heavy oil in an area they call Atlee Buffalo. And they've successfully changed 2 water floods. They call it the G pool and the F pool, but they're separate pools of oil. And they started injecting polymers to thicken the water and push more. And it's been very successful in both pools. So they have like tripled the production at Atlee Buffalo, but the G pool is fully developed and the F pool only has a few more drilling locations and then that will be fully developed. So the only criticism I had about Hemisphere was that it didn't have enough running room. They had nothing beyond Atlee Buffalo. And I kept talking to Don Simmons, the CEOs. They were looking at this deal, that deal, this deal, that, and they're not closing anything. And finally, they did. They've closed a deal called Marston. It's right on the border between eastern Alberta and Saskatchewan. And they started a pilot project. They have 5 horizontal wells. 1, 3, and 5 are producers, and 2 and 4 are injection wells. And they've been injecting polymers for several months, maybe not 4 or 5 months. And it takes quite a while before you really have confidence that the polymer flood is going to work. But if that works, Marston is significantly larger than Atlee Buffalo, and it could quickly ramp up to, really double their production within a few years. Now, the company is extremely cash flow positive, and especially now this time of the year, they never have done drilling during the breakup phase when the weather's, it's mushy, the ground's mushy, you can't move rigs around and stuff like that. So they will not start their drilling program until June this year. And as a result, because the wells in these polymer floods keep ramping up, even though they didn't complete any new wells in the fourth quarter, their production increased going into this year because the polymer floods are working. And they're up to over 4,000 barrels a day now, I think, or close to it. And I think it's going to plateau at about 4. But the question I get, and I'm sure you've gotten, is are their dividends sustainable? Because they currently have a dividend yield of like 9.3%. They pay quarterly dividends of 2.5 cents Canadian per quarter, and then twice a year, about every 6 months, they announce a special dividend of 3 cents. The balance sheet is in pristine condition. They have no long-term debt, no interest-bearing debt, and they are generating a lot of cash flow. Now, another reason, because they're not going to be doing much drilling in the first half of the year, their capital spending is going to be much lower, $5 or $6 million lower this year than in 2024. And so they'll actually have as much or more operating cash flow to pay dividends, through this year. Now, if Marston doesn't work and they don't have anything else coming on, then eventually Atlee Buffalo will start going on decline. But I've talked to him several times. He's constantly telling me they're looking at new deals all the time. So we'll see.
Well, Dan, let me just piggyback on that last point about the new deals, because we were on their case for the longest time that they should make an acquisition, years ago, and they finally did. And this new land package at Marston, they're going to do the same technique they did with the polymer floods. I think at Atlee they did water floods followed by polymer floods, and then they got that delayed gratification where, like as you say, the run rates stay pretty steady, and it's kind of a delayed gratification on those polymer floods. But when you see a company like this that's paying a nice dividend, you say it's sustainable based on their capital spend, you see that they've got nice growth, they're going to be drilling. Shouldn't they keep pressing the bet with acquisitions? Would you like to see a company like Hemisphere even go out and acquire something else, especially while oil prices are depriced? Is this a good window for a company like Hemisphere or some of the other profitable juniors to go out and mass up a little bit more?
Yeah, actually, if you're going out to make acquisitions, you're at an advantage if you have the cash in a depressed price market, right? Because the sellers have no leverage then. If you got guys that have to make a sale because they have bank debt due or something, this is the time to go out and do it. I like what In Play Oil did. They made a very nice acquisition that almost doubled their production, and it's another one that's in our high yield income portfolio. But no, I think they're not saying much about Marston. But reading between the lines when I talk to Don, I know he's very bullish on the project. And it will require quite a bit of capital to develop, but I think they can do it at a pace where they can keep paying their dividends and, add another 5, 6, 10 wells a year, because they're done with Atlee Buffalo. See, they've been drilling 9 or 10 wells a year at Atlee Buffalo, these horizontal wells, and they'll just switch that over to Marston. And man, then they may have like 10 years of drilling inventory there. And they'll be able to ramp that up faster than Atlee Buffalo declines. Now, I've talked to him many times about Atlee Buffalo, and he says, even when they stop adding new wells, as the polymers sweep through the reservoir, they will keep pushing more oil to the producers for several years before the well goes on decline, or before the field goes on decline. So anyway, it's not like, Atlee Buffalo's done, it's just going to roll over and go on decline. I don't think so. So they've got several years where they're going to be generating a lot of cash flow from that field.
So Dan, to your point about it can be a buyer's market for these companies that have cash when the underlying energy price is somewhat depressed, and some companies get underwater, or quite frankly, they need to raise money. But that's one thing that really stands out to me with these energy companies is that they spend a lot of money maintaining production and some trying to grow production. And then their extra capital, they return to shareholders. Shareholders demand that sort of income. Are there any companies out there that you have noticed that actually hold back some of that cash, are building up their balance sheet so that they are better prepared for these market downturns to take advantage of lower or cheaper acquisitions?
Yeah, I'll tell you right now, all of our Sweet 16 companies are free cash flow positive at $60 oil.
But I mean, maintaining money. Anyone that's built up their balance sheet, I can't get over how many times I've seen free funds flows of $100 million and the balance sheet sitting there with $5 million.
Well, so you get cash flow. You want to own companies that are building proven reserves and building production, and they're doing it with operating cash flow with some left over to pay dividends and buy back stock. That's exactly what Hemisphere is. And they do a great job at that, have great discipline. Now, if they're going to be constantly going out making acquisitions just every couple months or announcing another deal, then they're never building. Well, I mean, if you're making good quality acquisitions that are immediately accretive, and a couple of our companies, Ring Energy has done that, made 2 or 3 acquisitions in a row, and all 3 of them were immediately accretive to their cash flow, that's fine. But I mean, what Hemisphere did to buy this raw acreage in Marston, then that has to be developed before they start harvesting positive cash flow from that. But it's not a big, massive immediate tomorrow, we got to pump in $100 million or something. So I like that fact. The thing you need to look at on these companies now is, number one, first of all, you do look at the balance sheet and what is the situation on their debt. Do some of these companies have term debt that's the term ends here in the next 6 months or 12 months? Yeah, they got a problem because maybe they're not going to be able to roll that debt forward. Then you look at their hedges. And first of all, a lot of the companies do debt. In this business, the debt holders typically make them hedge a lot of production. So a lot of the smaller caps that I've found, they've got really good hedges in place, so they don't have much exposure to the near term, oil price pulling back. Now, if oil goes to 50 next year, then that could be a problem, but I just really do not see that happening. For one thing, I don't think OPEC's going to let that happen. So that's another thing. But yeah, I mean, you got to look at, what's their business plan, what's their growth plan. And, that's what I kind of do because I talk to them and I see what their 3-year plans, 5-year plans are. So I can build models to show how that's going to play out.
Well, Dan, speaking of small growth companies that have some free cash flow, another company that you brought up to us off mic, and this is something we want to bring to people's attention, is Rubellite Energy. It's traded on the ticker RBY on the TSX. And this is a small junior upstream company, small cap growth, but you think that they've got some good free cash flow setting up as well. So talk to us about the value proposition in Rubellite Energy.
Okay, see, I had never heard of Rubellite. And then one of our members, that a guy named Harry, he's 70 years old. He's got 40, 50 years of experience in the energy industry. Really, really sharp guy. And anyway, he brought it to my attention when it popped into his top 10 picks. He follows 82 companies, and it's like his number 10 best values play. So I take a look at this. This is like 6-8 months ago. It was the first time I looked at it. And actually, I asked Don Simmons if he knew anything about it. He says, yeah, I own their stock because it's another heavy oil company like his is. And he knows the CEO and everything. And so I had her on a webinar on last Monday, the 21st. And if any of your listeners want to listen to the replay of that, because she did a really good job, it's a little over an hour, but she goes through in detail. What I really love what they've done. Late in 2024, in October, they closed one big acquisition. And then, at the end of August, they closed one big acquisition. And then in October, they actually merged back into the company that they were spun out of. The company that spun them out is actually merging into, in a stock for stock deal, into Rubellite. It was called Perpetual Energy. And after both of these deals closed, they went from like 3,000 barrels a day to 12,000 barrels a day. And she told me as of the day we did the webinar, their production was over 12,200 BOE a day, about 70% heavy oil. But they've got gas, and they're in that deep basin play, where Peyto and those guys are, in that deep basin play where they could ramp up gas production really fast. And she's bullish about that LNG export facility that's coming online on the west coast of Canada. It's supposed to be online by the end of June. And that alone should cause Western Canadian natural gas prices to start to catch up with U.S. gas prices. And if that happens, this company's got a lot of potential. But it's really, the majority of their revenues are going to be from oil production, but they also produce NGLs and natural gas. But it looks really, really good. And if any of your listeners, they want to send it, I'll send them the link to the replay. And we are going to do a profile on the company here pretty quick.
All right. Thanks for that offer there, Dan. And look, you even did bring up that aspect when you were talking about Hemisphere, about the dividend. And yes, I have received a few emails that wanted me to push back a little bit and say, yes, some of these companies with 10, 11% dividends, and then sometimes even special dividends at these lower energy prices, a lot of people assume that these dividends are at risk, especially the special dividends. But how can we go about analyzing companies to understand if a dividend is solid at, let's say, current oil prices, or even around $60 a barrel? And how do we also need to balance that out with the CapEx spending? Because as you said, they could wind down some of their CapEx spending, but again, to me, is that sustainable dividends?
Yeah, and the one thing with Hemisphere is too, they're aggressively buying back their own stock. So I think the first thing that would give is they'd stop buying back stock. They'd halt that program. So that would give more free cash flow to pay for the dividends. And he has some hedges in place to protect the downside. He's got puts, he buys puts. So he keeps the upside, but he's protecting his downside with his hedging program. But yeah, you need to look at, these, but one way, join EPG. I mean, I prepare Excel spreadsheet forecasts that are macro driven, and all you have to do is go down to the bottom and change the assumptions for oil, gas, and NGL prices. Change the assumption for their production growth. If they say they're going to cut back and shut down their drilling program, you can just flatline their production or something. And it's real easy. I mean, in a matter of minutes, you can make those changes in the forecast assumptions, and it automatically updates their revenues, net income, and operating cash flow, and you can see if that operating cash flow covers their capital programs. So I think all of the companies that we have in our model portfolios that are upstream companies are all currently free cash flow positive. That's one of the things I really look for.
Yeah, Dan, just to comment on the work that you do. It's the write-ups that you do are fantastic, but also the spreadsheets are very helpful for working out your own valuations. You do a bang-up job at the Energy Prospectus Group, and I encourage people listening, if you follow the energy space, definitely get on Dan's list and start getting access to some of the information he shares with subscribers. One other company, we talked a lot about nat gas today. One other company that is a true gasser is Range Resources. It's traded on the ticker RRC. Now, we have talked about Range in the past, but it's one of the four gassers in your Sweet 16 growth portfolio. So not only are they going to capitalize if we see a higher nat gas price, but they've got growth on tap as well. Walk us through what you see with Range Resources, Dan.
Yeah, and I do own the stock, and I've been on board with them for over 20 years. Actually, Range Resources, I think it wasn't in the first Sweet 16. I started EPG in 2003, and I think in 2004 it was in the Sweet 16. It's been there ever since. And first class, super conservative. They are given credit for discovering the Marcellus Shale. They were the first company to successfully drill and complete horizontal wells in the Marcellus Shale up in Pennsylvania, southwestern Pennsylvania. They own over 1 million acres. They have, like, I think yesterday in their conference call, they said they have 30 years of drilling inventory. And another thing they have is an outstanding marketing group. They have recently joined a consortium or joint venture with two other companies to start building these natural gas-fired power plants within the basin, within, around Pittsburgh. Actually, Pittsburgh sits right on top of the heart of the Marcellus Shale, and they drill horizontally under the city. But they control a whole bunch of acreage that's held by production. Like, they've gone on a pad, maybe a 6-well pad, and they've completed 2 wells, one in each direction. Those 2 wells hold those leases forever. And so they've got hundreds and hundreds of development drilling locations which they can bring online quickly if they can just get the gas market to increase. But one of the problems is the gas pipelines coming out of the Appalachia area, which is, Pennsylvania, Eastern Ohio, and then the little northern part of West Virginia that sticks up in there has really good wells there too, is pipeline constrained. So this is great that they're going to start using it to generate electricity within the basin. And I think that's a really big improvement. And that's a big improvement for all of our companies that operate in there. But they announced first quarter results that just beat my forecast. I mean, they beat my free cash flow forecast by like $70 million. And the reason why is because of their good marketing group. They got higher realized prices. When I say realized price, that includes the regional differentials for quality or BTU content and also the cash settlements on their hedges. And they have a really good hedging program. And so they got higher prices for their gas, higher prices for their NGLs, and higher prices for their oil than I was using in my forecast model. So they beat the forecast like crazy. And they're really in good shape. Now, gas prices in the second quarter will pull back a little bit, but they're cushioned by some of their hedges in there. And then they're just in great shape for heading into the year end. And they in their presentation yesterday said their 3-year plan is to increase their gas production by 400 million cubic feet a day. So over the next 3 years, which is a very nice revenue stream.
Okay. Dan, the one thing I'm hearing from you quite regularly is check out these companies' hedges too. Just see how protected they are to the downside. But hey, Dan, great having you on the show. Again, Dan Steffens, president of the Energy Prospectus Group. Be sure to reach out to Dan Reed over his reports and sign up for the Energy Prospectus Group if you are invested or just interested in investing in the individual names in the energy sector, oil and gas. Everyone, thanks for tuning in to this weekend show. Just as a reminder, please go back through our website, podcast, YouTube channel, and Substack. Just search the KE Report. You can stay up to date with all our daily editorials, company updates covering the market moves day after day, and any key news out of a lot of the resource companies that we follow. Dan, again, thank you very much for your time. And everyone, thanks for tuning in this weekend. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.